Every day, millions of eyes turn to Wall Street, hoping to read the signs that tell us where the market is headed. But what really moves those numbers up and down? Is it the whisper of a Fed chair, the roar of a consumer spending surge, or the flash of a new technology? In the next 20 minutes, we'll strip away the jargon and draw a clear picture using simple sketches to show you the 5 core economic forces that shape Wall Street, how investors react, and what the future may hold. Whether you're in New York, London, Sydney, or Sao Paulo, these forces don't care about borders. They care about money, confidence, and expectations. Grab a pen, keep your curiosity sharp, and let's sketch the market together. Number 1 on our list, interest rates. Think of the Federal Reserve as the heart pump for the U.S. economy. The Fed adjusts the federal funds rate, the price banks pay each other for overnight loans. Those changes ripple outward like ripples in a pond. When rates go up, borrowing becomes more expensive. A tech startup that wanted to finance a new data center now sees its loan payments swell. That squeezes profit margins and analysts trim earnings forecasts. At the same time, higher yields on treasury bonds become more attractive, pulling money out of equities and into safer fixed income assets. The result? Stock prices often dip. When rates fall, the opposite happens. Cheaper credit fuels expansion, consumer mortgages shrink, and corporate cash flow improves. Investors chase higher returns in the equity market, pushing prices higher. It isn't just the Fed's moves that matter. Markets also price expectations. A single sentence from Chair Jerome Powell, "We're confident inflation is moving back toward our 2% goal," can swing the S&P 500 by a few points in minutes. Key takeaway: interest rate policy sets the cost of capital, shaping everything from corporate investment decisions to the relative appeal of stocks versus bonds. The second engine is inflation, the rate at which the general price level rises. A moderate, predictable inflation rate, around 2%, is a sign of a healthy, growing economy. Too low and the economy may be stagnant, too high and it erodes both consumer buying power and corporate margins. High inflation hurts households. If your weekly grocery bill climbs faster than your paycheck, you cut back on discretionary spending. Restaurants, travel, gadgets. That hurts revenue for a broad swath of companies, from retailers to airlines. For firms, rising input costs, materials, wages, shrink profit margins unless they can pass those costs to customers. If they can't, earnings shrink and stock prices fall. How does the Fed react? Usually by raising rates, as we just discussed, to cool demand. The market, expecting this, often preemptively sells equities when inflation data comes out hotter than forecast. Conversely, when the CPI comes in cooler than expected, it's a quick lift for Wall Street. Investors anticipate that the Fed may pause or even cut rates, leaving more cash in the equity market. Third, and perhaps the most intuitive, force is consumer spending. In the United States, personal consumption accounts for roughly 70% of GDP. In the UK, it's around 60%. When households feel confident, they spend, and that spending translates directly into revenue for companies, which then fuels earnings growth and higher stock prices. Why confidence matters? The Consumer Confidence Index, CCI, measures how optimistic households are for the future. A high CCI usually precedes a rise in retail sales, automobile purchases, and even big-ticket items like home renovations. Companies report stronger top-line numbers, analysts upgrade earnings forecasts, and the market rallies. A feedback loop. A rising market can boost consumer wealth. Think of a portfolio that's up 10%. That extra paper wealth can encourage further spending, a phenomenon known as the wealth effect. But the reverse is just as powerful. A dip in confidence, perhaps caused by a geopolitical shock or a sudden spike in unemployment, leads households to tighten belts. Retail sales falter, earnings disappoint, and the market slides. Takeaway: consumer spending is the fuel that powers corporate earnings. It is influenced by employment data, wages, and of course, the cost of borrowing we discussed earlier. When you hear a headline like U.S. retail sales up 2% in June, remember it's a direct signal to Wall Street. Number 4, political rhetoric and fiscal policy. While central banks control monetary levers, governments shape the tax, spending, and regulatory environment, often with equally dramatic market effects. A single speech can move markets. Remember when a U.S. president announced a major tax cut? The S&P 500 jumped about 4% the next day because investors priced in higher after-tax earnings for corporations. Conversely, a hawkish tone on regulation, say new tech industry antitrust rules, can send tech stocks tumbling. Fiscal decisions, direct government spending on infrastructure, defense, or green energy creates demand for construction firms, raw material suppliers, and equipment manufacturers. Lower taxes increase disposable income for households and boost corporate cash flow. Higher taxes have the opposite effect. International ripple, a UK budget that raises corporation tax, impacts not only British firms, but also multinational companies that report earnings in pounds, affecting global indices. In practice, traders monitor the calendar for budget days, election results, and central bank plus government joint statements. The market's reaction often depends less on the policy specifics and more on whether the tone signals certainty or surprise. Politics provides the narrative framework that shapes expectations, sometimes more powerfully than hard numbers. The fifth driver is perhaps the most intangible: investor psychology and strategic bets. Wall Street isn't just a passive reflector of economic data. It's an arena where billions of dollars are wagered based on expectations. Institutional players, pension funds, hedge funds, sovereign wealth funds have the resources to move markets through large coordinated trades. When a hedge fund signals a short sell on a sector, it can trigger a cascade of similar moves, amplifying price swings. Retail sentiment, amplified by social media, memes, and online forums, can create rapid short-term spikes. Think of the meme stock surges that caused the Nasdaq to swing wildly in early 2021. Derivatives and leverage add another layer. Futures contracts let investors lock in price expectations months ahead. Options give the right, but not the obligation, to buy or sell at a set price, allowing speculation on volatility itself. Psychology, fear, and greed are the twin engines. When fear dominates, say after a sudden rate hike, investors rush to safety, selling equities. When greed prevails, after a string of strong earnings, buying pressure intensifies. Even the most robust economic data can be overridden for a period by collective belief, positioning, and the strategic bets of market participants. First, defensive stocks. In uncertain times, geopolitical tension, lingering pandemic effects, or volatile rate environments, investors gravitate towards sectors that generate steady cash flow regardless of the economic cycle. Utilities, consumer staples, healthcare. These companies typically offer reliable dividends, lower beta, volatility, and predictable earnings. While they may not outperform in bull markets, they act as a ballast, preserving capital when the market jerks. Example, companies like Procter & Gamble or Johnson & Johnson often see less dramatic price swings during a rate hike cycle, thereby supporting portfolio stability. 7.2. Tech and AI. Risk-tolerant bets. Second, the tech and AI frontier. The adoption of artificial intelligence, machine learning models, and big data analytics is reshaping trading, risk assessment, and even corporate strategy. Hedge funds now use AI to scan terabytes of news, earnings transcripts, and social media sentiment in milliseconds, executing high-frequency trades that can capture tiny pricing inefficiencies. Opportunities: companies developing AI chips, cloud platforms, or autonomous driving tech are attracting massive capital inflows. Caution: valuations can become detached from fundamentals. A sudden shift in regulatory stance or a high-profile AI model failure can send shockwaves through this high-growth segment. Third, risk management is evolving from a compliance checkbox to a strategic advantage. Firms now blend traditional stress testing with AI-driven predictive analytics.
Technology integration, machine learning models forecast market-wide tail risk events like sudden rate spikes before they materialize. Broadening risk landscape beyond credit and market risk, firms now monitor ESG, environmental, social governance exposures, cybersecurity threats, and supply chain fragilities. Strategic shift, risk desks advise on product design, capital allocation, and even M&A decisions, turning risk awareness into a source of competitive edge. Customization, one-size-fits-all risk tools are being replaced by bespoke dashboards that match each firm's risk appetite, size, and sector focus. Takeaway, investors who understand how risk is being quantified and priced will be better positioned to pick the right mix of defensive, growth, and innovative assets. Let's bring it home. How can you, the viewer, use these insights to navigate Wall Street's next moves? 1.